Markets fell sharply on Friday as a new COVID variant was discovered in South Africa. The S&P 500 dropped 2%, and cryptos across the board are all down. Joining us today to talk about market action and more is David Barse, CEO of XOUT Capital. David, welcome back to the show.
David, thanks for having me again. Happy Thanksgiving.
Happy Thanksgiving to you too. Right, so great day for people, everyone in America celebrating Thanksgiving. Not so great for the markets, red across the board today. What's going on? Well, we know what's going on. There's fear. Is this changing your positioning or your outlook at all?
No, as you know, and we've talked about this many times before, we're a rules-based methodology, and we are fundamentally driven. So we wait for publicly reported financial statements to get filed, and then we accumulate that new information and allow it to populate our model, which derives its scoring system from 7 different fundamental metrics, and we make our quarterly rebalancing decisions after receiving that information on a day-to-day market movement like this, which is at least derived from a single new piece of information that emerged last evening. It's not going to change much for us in the long term. I think this goes back to our fundamental founding, which is there are businesses that are being impacted negatively by technological disruption, and the COVID scenario, which has been the primary driver to a lot of markets over the last almost now 2 years, isn't going away. We've said that before, isn't going to just go away. And so now what we're seeing is something new has arisen, whether they gave it a name or not today. I'm still waiting for that news from the WHO, but this is here to stay for folks, and people have to come to appreciate that the new normal will always have some impact from these coronavirus variants.
So then I got to ask you, would that just not mean you would take risk off the table indefinitely?
No, quite the contrary. As you know, I'm a long-term optimist, much to the dismay of many of your listeners and viewers. And they have a hard time accepting that one can be an optimist, and I understand that from their perspective. I don't agree with it. But what we're doing and what we spend all of our time doing is focusing on what companies and or industries are being negatively impacted by this speed of technological change and disruption. And so all we do all day long is spend our time focusing on which companies are being impacted on a negative basis to their long-term secular growth capabilities, and just eliminate them, and then let the winners take care of themselves. Whatever market environment we're in, whether it's a day like today or days like we've experienced over the last couple of weeks, which have been, great for growth markets. We had a phenomenal November until today. You're going to have companies that are being impacted negatively, and that's what we're spending our time focusing on. It's really a flipping of the investment paradigm.
Okay. Would it not change your outlook at all on some, sectors in particular? If you were to examine the bigger picture of what's going on, we've got a new variant that some say, again, not yet confirmed because there's still research of this, but some say might have the potential to overcome vaccines. Currently, we're seeing a few countries like the UK, Israel, for example, placing bans on travel, and South Africa, of course. And so what we're seeing now is a tightening global-wide of communication, of travel, and it just seems to me like everything's closing back down. Is that true?
Well, again, the people are making decisions. Countries are making decisions in a real-time basis right now, so they're being prudent and smart. Quite interesting. I had someone over for the holiday who had spent the last 2 years in Australia. Lockdown was stuck there, and to the benefit of those who were in Australia, because there was someone in school, and there were negative cases, 0 cases, sorry, in his community in Australia, because they shut the country down and wouldn't let anyone in. That's a course of action one can take to preserve some safety measures here. So clearly, travel and hospitality and industries that are impacted by decisions like that are going to be impactful. For us, again, it's about long-term secular decline. Our portfolio will rotate quarterly based upon previous quarter's fundamental financial information and how it relates back to periods in previous time periods. And I think we'll see adjustments in our portfolio, but not material adjustments. These are things that, as I said, are going to just continue to happen over time. There'll be another disruption event that will alter the course of our portfolio in the future. But technological disruption isn't just driven by what's happened with this new variant that's emerged. It's impacted by a lot of other things as well that are probably more material in the long term for companies that are trying to grow.
Mm-hmm. Okay. So going forward then, do you see today's reaction as the beginning of a sustained downturn, or do you think maybe markets are overreacting? This is a knee-jerk reaction and we're rebounding from here?
Yeah, I mean, I think what I've read is there were 100 cases in South Africa, and I don't know how many trillions of dollars of market cap was eliminated from the global markets as a result of this new news. I think deeper are the issues around whether they'll be able to come up with a new booster or a vaccine that will address this newer variant that might be able to escape our existing vaccines and boosters. Is this part of some longer term decline? I have no idea. I can't predict day-to-day markets and how they might react to information. One can say for sure this is not a lot of information on a shortened trading day during a holiday time period where many people are off desks and not thinking it through. Feels to me like a buying opportunity. But that's based on imperfect information. But again, the beauty of our strategy is it's a rules-based methodology. There aren't human beings overriding decisions that our model makes, which has proven over its 2 years and 1 month life that it can outperform a market like the S&P 500 in a material way by just excluding companies that are being disrupted.
Okay, so let's talk about the stocks that you like and don't like. We'll pull up a snapshot on the screen here. Your X'd out, your most recent quarterly rebalancing has some new additions to the fund holdings as well as new additions to the X'd out list. So Visa, JP Morgan, Bank of America, Walt Disney, Exxon, Coca-Cola, Verizon, Chevron, AT&T, and Wells Fargo. These have been removed from your portfolio. In other words, they've been X'd out or eliminated. These are stocks that you deem to be quote-unquote loser stocks. We've talked about your criteria before. They're things that you think are technological laggards, among other things. Your top fund holdings, I'm looking at this list. For the exception of Johnson & Johnson, United Health, and Walmart, everything else is a tech company. What about these large tech companies do you like so much, David?
Well, they're clearly the companies that are doing the disruption as opposed to the ones being disrupted. And again, picking them and picking the future winners that are on that list is a much harder thing to do. I like to focus on the 10 XOUT names because as you look at that list, they should be pretty obvious to folks. These are companies that are struggling with growth, struggling with the ability to adjust in this environment in which we find ourselves of constant change, constant disruption. And the one head scratcher for most people should be the top of the list, which is Visa. This is a technology company. So again, our model does not discriminate. Even technology companies can be disrupted or find themselves on the list of XOUTs. Visa is a new entrant to that list, and its reason is for the impact that it has had in terms of its ability to continue to grow. It's a global payments business, and that is one of the sectors that has probably been a ripe mining ground for technological disruption. There are many new entrants, many entrepreneurial companies, both public and private, that have sought to enter that marketplace and offer us a better solution, offer consumers, offer institutions a better solution for how we transact. And I think companies like Visa are having a hard time competing with that. And that's why its growth rate slowed down, why some other factors in our scoring system were impacted negatively, and it rose to being eliminated. So for folks, that should be one that people say, that's very interesting. How did that get on your list? The others should be patently obvious how those companies are challenged as we look into the future.
Tesla was on your XOUT list, albeit for not a very long time, and now it's back into your top fund holdings list. Tell us about that change. Was that because of price movement at all, or was there something fundamental that changed with the company?
No, in fact, as we look back on the decision regarding Tesla, the security price during the course of the quarter in which it was eliminated actually appreciated. So clearly, the stock price movement proved out to be a mistake for our model. But that being said, what had happened in the previous quarter, and again, we look back at a forward-facing risk. We look back on actual financial performance. And so Tesla's actual financial performance from the prior quarter had a deceleration in its growth rate. It also had some of the analysts that cover the company call for new stock price targets that were lower. Not every analyst, but many of the analysts. And there were some issues with respect to its own hiring practices that slowed down a little bit. So those factors weighed on the score. It became below the line. That is, we take the bottom 250 scores on our model and eliminate them. So it was right on the cusp of that line, and we eliminated it. As we put it back in, it was just, our rebalance occurred just before the announcement that they are now selling cars through Hertz and other rental car companies. And so the stock has appreciated significantly from when we rebalanced it in. So we've benefited from that stock price appreciation. But Tesla was an interesting study for us, if you will, because again, no human override. I did say at the time that I thought Tesla was likely to be one in which we X'd out over a short period of time. I didn't think it'd be as short as a quarter, but that's what the model decided to do. And now, I guess personally, I'm happy that the model put it back in the portfolio.
Did the Rivian IPO affect your decision at all?
Not in the slightest.
Okay, so you don't see any newcomers threatening Tesla's reign for now?
No, I mean, I think there are not just Rivians. You read about what all the major auto manufacturing companies are doing to commit resources and research and development to electric vehicles. It's the headline story every time a company like Ford or GM wants to try and give some folks good, positive information. Of course, there's also just the general trend of what's going on in the world with respect to regulating our society into electric vehicles, right? And so I think those changes are going to have long-term impacts, and companies like Ford and GM are going to have a long way to go to get close to what Tesla has been able to achieve as a so-called first mover advantage. They are just so far ahead of everybody else, and it's just misanalyzed. The company's been misanalyzed by the street since its inception.
Wow, it's remarkable you say that, given that the examples you gave, GM, Ford, they've had infrastructure built up over the last 100 years, and yet you're saying they can't keep pace with this. Basically, Tesla's a new kid in the block when you look at the auto industry, right?
Yeah, I am saying that, and I'm saying it because they're so far behind in terms of being able to develop, produce, and even though they might have manufacturing facilities all over the globe that they can retrofit, if you will, to the production of electric vehicles, to get to the place where Tesla is right now is a long way off. And I think, secondly, you can't look at Tesla and compare it to GM or Ford on a valuation basis. And that's what many of these analysts are out there doing. They're calling for Tesla stock as a wildly overvalued security because they compare it to the same kind of metric they use to evaluate GM and Ford, which are very different car companies.
Hmm.
As we know, and many have talked about, a company like Tesla is more than just an EV company. It's more than an auto company. It's more than a battery company. It's a technology company, and it's accumulated a massive amount of data, and that data has value, and no one gives much weight to the value of that data because they haven't yet put their hands around what the use value of that is. And so I think that's one of the major reasons why analysts have just missed it.
Very good. Finally, what advice do you have for investors watching right now who may not know what to do or have much experience with market action like today's, for example, when you wake up and news from another continent brought down, in your words, trillions of dollars of market cap all around the world across asset classes? What do you do?
Yeah, I mean, you look at these days as buying opportunities, as I said. You got to put the information and the market reaction into perspective, and obviously we'll learn more in the coming days. But if it does afford one an opportunity to enter at even a lower price point, if you will, that's a great opportunity. People should be focused on long-term investment fundamentals, pick companies that they hope will continue to grow and thrive through any kind of environment, and secondarily make sure that they're dealing with businesses and companies that don't have decisions taken away from them in terms of over leverage, where in some cases they don't have the control of their own destiny because they've levered their business to debt, and sometimes paying off debt in volatile markets becomes a greater challenge. So well-capitalized companies that continue to thrive and grow, that continue to disrupt, will do fine over different market cycles and the long term. It's just eliminate those challenging companies, which is what we do at XOUT, that are over-levered, that are having trouble growing, and use these kinds of days as entry points, because that's the way one should invest. Don't buy when markets are rising, buy when markets are shrinking.
Well, don't catch a falling knife is also an expression that some people say.
Yeah, but we're talking about a broad portfolio of securities, not individual stocks, where I would agree with that. You don't try and catch a falling knife in an individual stock, but generally speaking, you are mitigating your risk by diversifying with a broad-based portfolio. And when you have that opportunity where all companies in markets are being impacted, I think, look, one of the stocks that's had probably the worst quarter, Peloton, is one of the few I see that has green on my screen today, right? It's sort of silly, isn't it? I mean, because of one day's new information, we're all going to get back on our Peloton bikes and start riding. I mean, it just shows you, if you want to dig deep into this, it can become a little silly. So use these as buying opportunities if you're entering broad-based portfolios.
I see. Okay, well, that's very good insight. Thank you, David. Thank you for coming on the show today.
Hey, thank you for having me again, and happy holidays, and look forward to speaking to you after the new year.
Yes, absolutely. And thank you for watching Kitco News. I'm David Lin.